All right, folks. We've got some major developments happening right now regarding the ongoing tariff situation between the European Union and the United States. Things are moving fast, and there's a lot to unpack. Just breaking, the European Union has put an offer on the table for the United States: abolish reciprocal tariffs on industrial goods. This comes alongside news that the European Union states it's prepared to engage in discussions about zero-for-zero tariffs with the U.S. This is a significant shift, especially considering the broader economic context. We're seeing a whirlwind of activity. The Federal Reserve is holding a closed-door meeting today, sparking rumors of a potential emergency rate cut. Simultaneously, former President Donald Trump is actively tweeting, really driving home his stance on the importance of interest rate reductions. On top of that, we're observing interesting trends in commodity markets, with oil and food prices showing downward movement and some inflation metrics hitting multi-year lows. It's a complex picture with many interconnected pieces. Today, we're going to break down these events, explore the potential strategies at play, particularly concerning Trump's objectives and the Fed's possible responses, analyze the inflation data, look at the global reactions, especially concerning China, and examine the market sentiment and recession probabilities. There's a lot happening globally, so let's get right into examining these developments. Stick around until the end, because that's where we'll summarize everything and offer some key takeaways and conclusions. If you find this analysis valuable, please consider hitting that like button and subscribing to our channel. It genuinely helps us grow and continue bringing you this content. Also, drop a comment below letting us know where you're watching from. It's always great to see our global audience. The European Union's recent proposal to the United States, suggesting the elimination of mutual tariffs on industrial products, marks a notable change in the trade dynamics between these two major economic powers. This offer, coupled with the EU's stated readiness to discuss a zero-for-zero tariff arrangement, arrives amidst a backdrop of shifting global trade policies and economic uncertainties. It's particularly interesting when viewed against the EU's previous posture. Not long ago, there were strong indications and rumors that the EU was preparing to retaliate against any new U.S. tariffs, much like Canada did, by imposing equivalent duties on American goods. The narrative suggested a tit-for-tat escalation was likely. However, within a remarkably short time frame, seemingly around 12 hours after those rumors intensified, the EU pivoted to a more conciliatory approach, signaling openness to negotiation and tariff removal. This rapid change warrants a closer look. What prompted this apparent shift in strategy? Several factors could be influencing the EU's decision. Internal economic pressures within the Eurozone, perhaps related to slowing growth or specific industry concerns, might be playing a role. The prospect of further trade friction with the U.S., potentially exacerbated by Trump's known leverage-based negotiation style, could also be a motivating factor to seek de-escalation. Furthermore, the complexities of the EU-US trade relationship extend beyond simple tariffs. The European Union utilizes value-added taxes, VAT, and maintains distinct regulatory standards, which already impact the cost and accessibility of U.S. goods in European markets. Therefore, a zero-for-zero tariff agreement might not level the playing field entirely, and these underlying mechanisms would likely form part of any comprehensive negotiation. The EU might perceive an advantage in negotiating from a starting point of zero tariffs, potentially shifting the focus to these other non-tariff barriers where they might feel they have a stronger position, or where adjustments could be more strategically managed. Understanding the nuances of how VAT is applied to imports and how differing regulations affect market access is crucial to grasping the full implications of this offer. It's not just about removing the headline tariff rate. It's about the intricate web of economic policies that shape trade flows. This shift suggests the EU might be recalculating the costs and benefits of a potential trade dispute versus finding common ground, even if the path involves complex discussions beyond just the tariffs themselves. Please make sure to watch this video until the very end, as we will be providing crucial conclusions and summarizing the key points. The European Union's apparent change of heart on tariffs doesn't exist in a vacuum. It intertwines directly with the broader economic strategies and political maneuvers unfolding, particularly those involving former President Donald Trump and the Federal Reserve. Trump has been notably vocal, utilizing his platform to relentlessly advocate for interest rate cuts by the Fed. His recent tweets underscore this pressure, framing rate reductions as essential for economic vitality. This public campaign connects directly to the tariff situation. One interpretation suggests that the imposition or threat of widespread tariffs is a calculated tactic by Trump, not solely aimed at addressing trade imbalances directly, but also as a mechanism to influence macroeconomic conditions and consequently compel the Federal Reserve to lower interest rates. The logic follows that tariffs could potentially slow economic activity or introduce inflationary pressures, though current data presents a mixed picture on this, as we'll discuss, creating conditions where the Fed might feel obligated to ease monetary policy. The timing is also critical. Achieving these rate cuts early in a potential second term would align with Trump's stated economic goals. Adding another layer of intrigue is the Federal Reserve's announcement of a closed-door board meeting scheduled for today. While the specific agenda remains undisclosed, such meetings inevitably fuel speculation, especially given the current economic climate and Trump's persistent calls for action. Rumors about a potential emergency rate cut, though perhaps improbable based on market odds, highlight the heightened anticipation surrounding the Fed's next move. Market prediction platforms, like Polymarket, reflect this uncertainty. While the odds currently suggest no change in the upcoming May meeting, around 72% probability, the picture becomes less clear for subsequent meetings in June and July, where the likelihood of a 25 basis point decrease rises significantly, around 56% for both months according to recent odds. The very existence of odds for an emergency rate cut, even if low, around 24% recently, signifies the market's sensitivity to the confluence of trade tensions and monetary policy expectations. Trump's strategy appears multifaceted. Use tariffs as leverage in trade negotiations, while simultaneously creating economic conditions that pressure the Fed towards his desired monetary policy path. Lower interest rates, sooner rather than later. The EU's offer might be seen, in this context, as one reaction to this complex pressure campaign. As we analyze the push for lower interest rates and the role of tariffs, the actual inflation data presents a somewhat paradoxical picture. Former President Trump explicitly states in his tweets that food prices are down, there is no inflation, pointing to lower oil prices as well. While the claim of no inflation is an overstatement, some non-traditional metrics do suggest a significant cooling trend. Notably, Truflation, an alternative inflation index, was recently measured at a remarkably low 1.1%, reportedly its lowest level in 4.5 years. This contrasts with official Consumer Price Index, CPI figures, which might show slightly higher, albeit potentially moderating, inflation. This discrepancy highlights the ongoing debate about how best to measure real-time price changes experienced by consumers. Regardless of the precise metric, the narrative of declining inflation is crucial for Trump's strategy. Lower inflation figures strengthen the argument for the Federal Reserve to cut interest rates, as maintaining higher rates becomes less justifiable if price pressures are genuinely subsiding. However, the role of tariffs in this inflation equation is complex. Conventionally, tariffs are expected to increase the cost of imported goods, potentially leading to higher overall inflation. Yet the current situation is more nuanced. It's possible that the threat of widespread tariffs and the resulting economic uncertainty are actually dampening global demand and slowing economic activity, which could, counterintuitively, contribute to lower inflation or disinflation in the short term. The economic turmoil created by the constant back and forth on trade policy might be suppressing price pressures more effectively than the direct cost-increasing effect of the tariffs themselves. Therefore, while Trump points to low inflation as a reason for the Fed to cut rates, the very tariffs he champions might be indirectly contributing to that low inflation environment through increased economic uncertainty and dampened activity, rather than through their expected price-raising channel. The upcoming official inflation data release, particularly the figures around April 10th, will be closely watched to see if these trends continue and how they align with the competing narratives surrounding tariffs and monetary policy. The trade relationship with China remains a distinct and central element within the broader tariff discussions. treated quite differently by the Trump administration compared to allies like the European Union. While the EU is being offered potential zero-for-zero tariff arrangements, Trump has consistently signaled his intention to maintain significant tariffs on Chinese goods. The primary justification cited is the massive, long-standing trade deficit the United States runs with China, which Trump views as fundamentally unfair and detrimental to American industry. This focus on China is directly linked to the administration's goal of reshoring manufacturing, bringing industrial production back to the United States, reducing reliance on Chinese supply chains, and creating domestic jobs. The tariffs are seen as a key tool to incentivize this shift, making Chinese imports more expensive and US-based production relatively more competitive. However, the situation is further complicated by other geopolitical and economic factors, notably the ongoing saga surrounding TikTok. There has been speculation, fueled by hints from Trump himself over the past few days, that the tariffs could be used as leverage in negotiations concerning the ownership and operation of the popular social media app. The idea is that a partial rollback of some tariffs might be offered in exchange for concessions regarding TikTok, potentially forcing its sale to American interests or ensuring stricter data security measures. This illustrates how the tariffs on China are not just about trade balances, but are integrated into a wider strategic negotiation involving technology, national security, and data privacy concerns. Even if a deal involving TikTok were reached, it's highly unlikely that all tariffs on China would be removed. Trump's core commitment to addressing the trade deficit and promoting domestic manufacturing suggests that substantial levies would remain in place, regardless of other negotiations. China, facing these targeted tariffs and the potential loss of access to the vast U.S. consumer base, would undoubtedly welcome negotiations aimed at reducing these duties, but the administration's specific focus on the trade deficit and the unique geopolitical context make a zero-for-zero outcome, like that proposed to the EU, seem improbable for the U.S.-China relationship in the near future. The strategy here is clearly different, emphasizing sustained pressure and structural change over reciprocal tariff elimination. The ripples from the U.S. tariff strategy extend far beyond just the European Union and China, impacting numerous countries and prompting varied global reactions. We're hearing reports and rumors that several other nations, including Vietnam, Israel, India, Canada, and Mexico, are also expressing interest in negotiating zero-tariff arrangements with the United States. Each of these relationships, however, carries its own unique history and economic context. Canada and Mexico, for instance, already operate within the framework of the USMCA, United States-Mexico-Canada Agreement, which replaced NAFTA, suggesting that any further tariff discussions would happen within that existing structure, potentially involving renegotiations or clarifications of specific provisions, rather than entirely new blanket agreements. Mexico has already indicated it likely won't impose reciprocal tariffs, possibly anticipating future renegotiations post-Canadian election, a sentiment likely shared by Canada itself. Countries like Vietnam and India, rapidly growing manufacturing hubs, see an opportunity to potentially capture market share lost by China due to U.S. tariffs, making a zero-tariff deal highly attractive for their export-oriented economies. Israel, a key strategic ally, likely views tariff negotiations through both economic and geopolitical lenses. The overall effect is a complex web of bilateral and multilateral discussions, spurred by the initial U.S. tariff actions. Adding to the complexity was the recent rumor, though officially denied by the White House as false or fake news, that Trump was considering a 90-day pause on imposing new tariffs on all countries except China. While debunked, the mere existence of such a rumor is telling. It could reflect internal administration debates, trial balloons floated to gauge reactions, or simply market jitters about the unpredictability of tariff policy. If such a pause had been implemented, it might have signaled a temporary shift in tactics, perhaps an acknowledgement of the negative impact tariffs were having on the stock market, or a move to allow negotiations to proceed without immediate escalation pressure on allies, while maintaining maximum pressure on China. The denial suggests the administration is sticking to its current course, but the incident underscores the uncertainty surrounding the implementation and potential adjustments to the global tariff strategy, keeping international markets and trading partners constantly guessing about the next move. The constant flux in trade policy, tariff threats, and monetary policy speculation inevitably impacts market sentiment and fuels fears of a potential economic downturn. Observing market reactions, such as through heat maps like those provided by FinViz, often reveals a sea of red one day and green the next, reflecting the significant volatility driven by this uncertainty. We see conflicting signals constantly. Reports of low inflation, which should theoretically support markets, are juxtaposed with the looming threat of new tariffs, which tend to spook investors. Added to this mix is the anticipation surrounding Federal Reserve actions. Will they cut rates, hold steady, or even hike? Each possibility sends different signals to different market sectors. This complex interplay is mirrored in market predictions regarding a U.S. recession. Platforms like Polymarket show the odds fluctuating. Recently, the chance of a U.S. recession occurring in 2025 was pegged at around 57%, down from highs near 65 or 67% just days or a week prior, but still significantly elevated from earlier periods where it might have been closer to 39%. This suggests that while immediate fears might ebb and flow based on daily news, underlying concern persists. The narrative of a potential Trump-induced recession caused by the economic disruption of his tariff policies competes with arguments pointing to broader global factors or the natural end of an economic cycle. The actual gross domestic product, GDP growth figures are critical here. If the first quarter, Q1, GDP comes in negative, recession fears will likely intensify significantly. Conversely, positive Q1 growth could alleviate some immediate pressure, although concerns about subsequent quarters, like Q2, would remain. Ultimately, the recession probability is a moving target influenced by actual economic data, GDP, inflation, employment, Federal Reserve decisions, and the outcomes of ongoing trade negotiations. The tariffs act as a major wildcard, potentially slowing the economy directly through costs and uncertainty, while also indirectly influencing the Fed's decisions, creating a feedback loop that keeps markets on edge. So, pulling all these threads together, what are the key takeaways from this complex economic and political landscape? We've seen the European Union make a significant offer to the United States regarding 0-for-0 tariffs on industrial goods, a rapid shift from their earlier stance of potential retaliation. This move appears linked to former President Trump's aggressive strategy, which involves not only direct trade pressure, but also a clear attempt to influence the Federal Reserve. Trump has been explicit in his calls for lower interest rates, highlighting declining oil and food prices and low alternative inflation metrics like truflation as justification, even as the Fed maintains a cautious stance and holds closed-door meetings. His overarching goal seems to be forcing the Fed's hand to cut interest rates as early as possible in a potential second term, using the economic conditions created or threatened by tariffs as leverage. The global reaction has been widespread, with numerous countries expressing interest in negotiating tariff reductions, though the specific dynamics differ, especially concerning China, where tariffs remain a key tool for addressing trade deficits and promoting domestic manufacturing, potentially tangled with issues like TikTok. Market volatility reflects this uncertainty, with recession odds remaining elevated despite some cooling inflation indicators. The rumor of a tariff pause, though denied, highlights the unpredictable nature of the current trade environment. Ultimately, the situation reveals a high-stakes balancing act. Trump appears willing to risk short-term economic disruption and market volatility, betting that these pressures will achieve his long-term objectives, forcing favorable trade deals, encouraging the return of domestic production, particularly from China, and perhaps most critically in his view, securing lower interest rates from the Federal Reserve. Whether this aggressive approach leads to sustained economic benefit or triggers unintended negative consequences, like a deeper slowdown or strained relations with key allies, remains uncertain. The negotiations with the EU and other partners, the upcoming inflation reports, the Fed's actual decisions in the coming months, and the Q1 GDP figures will all be critical indicators of how this strategy is unfolding. It's a period defined by strategic pressure, economic uncertainty, and the undeniable influence of political objectives on global trade and monetary policy. Thank you for sticking with us through this detailed analysis. Remember to like, subscribe, and comment below with where you're tuning in from.